let's talk about SPACs versus IPOs. First of all, assume 80% of people listening to this don't know what a SPAC is. 20% do, and they've heard about it. So why is everybody talking about SPACs versus IPOs?
Got it. So a lot of people out there, entrepreneurs, think about having your own company and saying, how did Facebook get on the market? How did Twitter get on the market? Well, you build your company up and then you work with a New York bank, a Goldman Sachs, Morgan Stanley, Merrill Lynch, folks like that, and they do what's called IPO, initial public offering, and they get you on the stock market. Now, the bank is in charge of all that, and a lot of times the bank, they got heavy fees and stuff. There's an alternative out there. It's called SPACs, and it's like a short way to get on the stock market. And what's very, very interesting that I think that most people don't know is how this gets gamed. Because the money that your company will get is the first day IPO. So when you go on the stock market, the company gets a bunch of money on the first day, and then the company's traded on the stock market. And then you can take that money, build your company, and do all these kind of great things in the future.
So a faster version of going public rather than taking the IPO.
Correct. And what's very interesting, and I'll give you an example. Many people, you don't have to understand SPAC or IPO to notice, hey, that company just went public, and they see this jump in the stock price.
Yeah.
Wall Street Bets will tell you about it. If you're on Robinhood, you see it all about it. It's very easy to see. You don't really have to know a lot of details to notice it. And hey, Kai, put up Poshmark. So you have Poshmark, really cool company. Where people are reaching into their closets, taking fashion, and they can trade.
It's like secondhand retail.
That's right, and it's like an eBay for curated fashion, where you could sell what's in your closet that's not too old. So Poshmark goes out on day one. They sold
IPO or a SPAC?
IPO, and it was Goldman and Morgan that walked hand in hand down the aisle to do this one. So they went out, and a bunch of people at high net worth people at Goldman and IPO were invited to buy in at about 42 to 49. Look what happens within 2 days, all the way up to 100. And then this one just happened in January, and then it goes down. You know why it went? Because all those people, Goldman and Morgan, those high net worth people that saw the thing pop day one, they're like, I've just doubled. Maybe I'm out. And so now it levels out down to a more rational, where is it today? Like 50 or something?
51.
Yeah, 51. So it's above its IPO value a little bit, and now it's going to grow into its...
Still made 25%. You're just going to make 100%.
That's exactly right. But the point is that pop there, if that was really the value of the company, this should have gone out maybe at 75. And that would have been more dollars for Poshmark on day one. They got the first day price, like 49. So it's kind of game. So the IPO game is kind of game by the banks.
Who wins in the IPO game? Who wins in the IPO game?
The IPO game, the banks win, and the high net worth people and the big institutions that buy your IPO price the day before the pop, and then they sell out.
That's in the IPO.
That's in the IPO.
Who wins in the SPAC?
The SPAC, the company still gives up a percent of itself to go public, but the pricing is much more rational, and you work with the SPAC partner, and it's more rational, and you have less of this hidden game, this week one game. And so the bad side of SPACs right now is there's too many SPACs. And so if there's too many SPACs and not enough good companies, bad companies are going to get out, because some SPAC will say, well, you're not really that perfect yet, but I'll take you public.
What's a bad company? Not a real product, just future projections. You don't have past projections. You're just kind of like, here's what we're going to do next 3 years. And you say, what have you done last 3 years? And you have nothing to show for.
Your growth is less stable. Your profitability is not there. Maybe you're a little smaller.
So let me ask you this. If I created a SPAC myself, and you and I put a couple $100 million, and we're doing it at $10 with 50-cent warrant, whatever.
That's exactly right.
Okay, so say we have that, right? Okay, we put a couple $100 million in there. What kind of companies are we not looking for to put in the SPAC, and what kind of companies are we looking for to consider putting into our SPAC?
3-year-old venture company that hasn't yet grown into profitability and gotten above 25 million in sales is probably sketchy.
So don't touch that one.
Don't touch it.
But they're touching it, and that's where shit's hitting the fan.
Correct.
Okay.
That's the criticism of SPACs, is that the lower quality companies are getting out because there's too many SPACs out there right now. It's like, there's great companies out there that entrepreneurs putting together and are going to get out. So,
Pat, you brought up something yesterday
but give me the other one. Give me the other one that you would. We have a couple $100 million, $10.
Metromile just went out with a SPAC.
Yep.
I think highly of them. They're redoing car insurance, over $100 million in sales, and so
it's a real legitimate company.
Legitimate company.
So instead of waiting 18 months, go 90 days and go with a SPAC.
Yeah, exactly right. Be ready. You got to be ready for it.
Speaking of Metro Mile, you did a case study, Metro Mile versus Root. I watched it. I tried to, not only am I on Valuetainment Economics, I watch it. I'm a subscriber because I learned from the Biz Doc.
The Hair Club for Men. I'm also a customer.
Exactly. Not only am I the president, I'm
also a customer.
Yeah,
Remember
you're gonna
that guy?
like the way you look. I guarantee it, Tom. But anyway, I listened to that episode. You were in Hawaii. Lucky you, doing episodes from Hawaii, looking good, drinking a Mai Tai, I believe. You were slightly drunk, but we're not calling you out. You were having a good time. But you were doing an episode on the Spac of
the
Metro Mile.
last 5 minutes of the case study was a little inebriated.
Little shaky at the end, but it's all good.
Tom doesn't remember doing the case study.
That's right.
I did a case study. I don't remember that. And then you did, it was Metro Mile versus Root. And it was actually very informative. But I mean, I'm of the 80% that was like, what the hell is a SPAC? I never even heard about a SPAC until basically our good friend Chamath Palapatia started talking about it over the last, 12 months.
He's all about it.
He's all about it. He's all about that life.
And he's got the track record.
He's got the track record.
He did well.
You brought up something yesterday, Pat, when I said, well, what's the deal with the SPAC? And you said, it's all about speed. It's all about speed. It takes less time. So anyway, what is that?
I mean, if you want to go public, it can cost you $4 to $10 million. I'm giving a low to high. It's about a $6 million number. Is that about a right number?
Absolutely fair. A ton of things you have to do.
So $4 to $10 million, legal fees, CPA, accounting, audits, headaches. You're going to have a handful of people in your office for 6 months just sitting there going through every single thing to prepare. And then Goldman, Morgan, Merrill, whoever it is that's going to take you, they're going to go
telling you how beautiful you are.
They're going to have to go sell you. It's a mess when you go public through the IPO. SPAC, boom. 90 days. If you're good, we're out. And you're on the market, ding, 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 ding. You're on the market if you go through the SPAC. If you have a real business. If you don't have a real business, guess what they will do if you go on a SPAC? You will be trashed by the media.
Oh my gosh.
If it's not a real business.
Why will they trash you? What is it?
Because it's fake. You're trying to make money by manipulating the stock and saying, here's what we're creating, here's what we're going to be, here's what we're building, but you don't have any of that built today. And if you keep saying, here's what we're going to do, watch us, and nothing happens with the watch us, people are patient for a month, maybe 3 months, maybe 6 months, maybe 12 months. But eventually, if you can show proof in the pudding on what you're creating, that's when backlash comes.
Let me ask you another question.
Professional analysts are out there to protect the shareholders.
A lot of this is sort of big macroeconomics. Should I go SPAC? Should I go IPO? How does this affect our listeners out there? Like, what should they be aware of? Is it when they're investing, where they're looking to allocate their capital? Is it just knowledge? Where should our listeners be following this?
First of all, the education is key. But this isn't even about the education. I'll give a completely different angle of it. Tom is sitting here. For people that don't know Tom, if you know Tom, Tom is a guy that did very well in business. If you ever seen the interview between Steve Jobs and Bill Gates, the last great interview between the two in the red chair, you know which one I'm talking about. Pull up the picture. Don't play the video because in case the folks out of Silicon start knocking on the door. Put Steve Jobs, Bill Gates' last interview. You probably have seen it. I mean, the world saw that picture right there with them going at it. Like, it was very, very emotional. It was intense. It was awesome, right? There was 300 people in that room. Tom was one of them, that were invited to be in that room. Tom was a Silicon Valley guy. Tom was a technology guy. Tom was a guy that participated in 4 companies going, and they sold it for over $1 billion. That's what Tom's resume is. Former professor, adjunct professor at Pepperdine. I think Loyola Mount. Am I missing one of them? Biola was what he was teaching. So
he's no rocket scientist, but he's doing
no
okay.
rocket scientist, but his dad was. His dad was a rocket scientist.
Son of a rocket.
Son of a rocket scientist. But the point is the following. If you have the ability to go run with a person you believe in, that you think is crazy enough to do what they're saying they're going to do it. And you become a voice, you become a leader. You own a piece of that company, and that company takes off, and you own some shares, and you bring value to that company, you can experience some nice exits. I lived in communities. My last 10, 15 years, I live in communities where people, you talk to them, how'd you make your money? You'll hear them say, it was either the inheritance is actually a very small percentage,
less than 10%.
Self-made millionaires 90%. Self-made billionaires, yes, that is a 70% that's self-made, 30% that the money was passed on, like the Walton family, all these other guys. But 70% of billionaires, 90% of millionaires are self-made, right? How'd you make your money? Oh, real estate. How'd you make your money? Oh, stocks. How'd you make your money? As part of a company. The company went public. I own some shares. I was there early. I got my exit. I got my $16 million check. You don't know this person.
Right,
I got my $22 million check.
Mm-hmm.
I got my $41 million. The world doesn't know $40 million people.
Yeah.
You could be sitting next to a guy that's got $42 million from an exit that he had, and he's sitting pretty. He's set. He's got good things, good life. So anybody that's watching this and you're hearing us talk about IPO or SPAC, my challenge and sort of an inspiration to you would be try to figure out a way to get into that circle and go contribute to a company that's potentially going to go public or have a SPAC or be of value to that company. The upside could be exponential. Even Mario. Mm-hmm. Mario was a guy that started with me early. You got Mario, Moral, Tikrin, who started Lexus, and then you got some of the guys from Amor, big, Tom himself. Tom's one of the biggest shareholders in the entire company. I think, Tom, you're like the third biggest shareholder in the company, third or fourth biggest shareholder in the company. Look at the smile on his face, right? Third or fourth biggest shareholder in the company. So, but if you go back and you think about Jose Gaitan, right? Mm-hmm. Jose Marlin Gaitan, big shareholder, right? You think about a Palayo, you think about even Sapalas that came later on. So these guys come in, they get, and by the way, there's a lot. We have like 250 of them, but some more than less. You come in, you get the shares, you contribute, the company does well, then you have an exit. So I think what I take away from IPOs and SPACs is go find one and bring a ton of value to that company with the hopes of earning the rights to get some shares. So hopefully you can have your own exit as well one day. Mm-hmm. That's how I process that when I see that. Do you have feedback on that, Tom?
Great advice.
No, absolutely.
He's just smiling over there.
I'll tell you about a guy. There is, going back at Jamdat, there was a producer, a games producer. And if he's listening, he knows who he is. It's Travis. And Travis wanted to know, how do I get more equity? How do I get more equity? And he wanted to know, how do I build value for the organization? How do I build the organization's value? And he never was a guy that came in and said, hey, they're hiring over at Electronic Arts or Activision. Can I have another $10,000 a year in salary? He never
just
did that.
Just asked for shares.
He asked for shares, but more importantly, he was like, how do I impact the valuation of the company? And by the way, that's the attitude what Patrick just said. That's the attitude you walk in. Hey, how does my job increase the value of this company? I just want to know how I can be really, really good at it. I need health insurance, so I got to have enough to live and do things like that. But I'm willing to make a bet here and drive on value.
Yeah,
and you walk in there, you're going to have an entrepreneur hug you and say, I will take care of you, and this is how you do it.
FYI, we just recently interviewed an executive. I won't give the name, okay? Here's how the interview went. Look, pay me whatever salary you want to pay me. It's great. Whatever you want to pay me the salary. But I'm more interested in equity and participating in the victory. So pay me there. I don't care what my salary is. Let me participate in this. That comes from a person with experience, okay? And then when you learn more about the person, you realize why the person says, pay me in equity, not in, because he had an exit in the past or one or two or three exits in the past. So you had a guy that was working for you years ago, goes to Snap, has an exit, gets $40 million, and he was a guy that reported to you.
Correct.
That's a pretty nice exit to have, right? So those things happen to a lot of people. That's the part about working for an established company, and that's the part about working for a company that's steadily grown where you can have a big upside. So if you enjoyed this little short segment from the podcast that we did, here's another short segment to watch. Or if you want to see the entire podcast, click over here. Take care, everybody. Bye-bye.